And so Liberation Day, I think we were all excited when he announced reciprocal tariffs. It was only when that chart went up and the calculation of reciprocal came back with a number, a cube of the expected, sort of tariff rate. And, what we kind of have to remind ourselves about Trump, whether it's his dealings with universities or his dealings with, other countries, is he has a certain negotiating style, I guess I would describe it, which is very aggressive, asks for a lot. And also he promised that if a country retaliated, that he would retaliate even further. And that's how we got to 145% tariffs with China. So I think he sort of made his point in a very significant way. I think the world has had the opportunity to experience what the impact of effectively shutting down trade with China will mean, both for China and for U.S. businesses and the U.S. economy. I think he sort of made a similar point kind of more broadly with other countries. I think the pause was a very good idea. And I think, the ability to use this pause to make, the beginnings of deals with other countries, I think can head us in the right direction. The point I made over the weekend and kind of tried to make it a little simpler today is that I think keeping tariffs at 145% with China is a mistake for many reasons, but even from a negotiating perspective, it's critically important in a negotiation that you are in the strongest possible position. And the 145% tariff is going to have a very negative effect. It's already having a negative effect on all businesses that in any way source, product in China, in particular smaller businesses that aren't going to warehouse huge amounts of product, not that many companies do at this point in time. Imagine the Omaha toy retailer, right? And the sources probably nearly 100% of their products in China. They cannot afford to buy inventory that costs, 145% more, and nor are they going to be able to raise their prices to a level that will enable them to remain profitable. This is going to be, it's putting a huge strain on small companies and also has a negative effect on our economy. So my advice to the president, pause the China tariffs or take them down to 10 or 20%. And then actually kind of the balance of power in the negotiation comes back to us. And the reason for that is the shock of the tariffs has really caused, every CEO, every owner of a business that has sourced, a meaningful percentage of their product in China is doing everything they can right now to find alternative sources of supply. And the longer that China sort of doesn't make a trade deal with the United States, the higher the probability is that everyone leaves. And that has a potentially long-term and devastating effect on the Chinese economy. So by taking the tariffs down soon, takes the pressure off of our companies, our economy, puts the sort of negotiating power even more so in the president's favor. And I think that accelerates an outcome. The risk of all of this is, I would say, the shock of the tariffs and the shock of the Trumpian approach here is that, with the potential is to kind of destabilizing sort of the economic and in some sense the global world order, causing a loss of trust in the United States as a trading partner over the long term. That kind of, people do not like to see that kind of extreme unpredictability. When you see extreme unpredictability, cost of capital in general rises. So, people would argue they don't want to receive a higher premium on U.S. Treasuries. They want to receive a higher premium on investments in U.S. equities. And, the unknown is this sort of, even if we resolve this reasonably quickly, and we do get the benefit of a pause that gives us time to negotiate deals, will there be a persistent cost, right? You can save money on tariffs, and you could end up in a worse place if our cost of capital, our equity and debt cost of capital, are the yield we need to, price our treasuries at is higher. With $37 trillion of debt, 25 basis points, is a lot of money. And so that's a vulnerability that we need to think about.